Mortgage rates have fallen to some of their lowest levels in more than a decade. In fact, advisors say today's home loan rates are the second lowest in the past 15 years. So for homeowners, the real question now isn't when to act, it's how to structure your loan when money is already cheap. To understand why timing matters less now, it helps to look at where interest rates are and where they may be headed. Singapore mortgage rates have dropped from close to 4% at their peak to as low as the mid-1% range. These rates have broadly moved in step with US interest rates. The question now is how long rates stay low and what homeowners should do in response.
So if you look at the level of SING rates right now, independently, is 1%. And typically, when interest rate is that low, it tells you that the economy is not doing well. Like if we bring ourselves back to 2020, 2021, that kind of years where we had a pandemic, things are not looking well, a recession. Right now, clearly, we are not in that kind of backdrop. Yeah. So in terms of nominal rates, I think there's a lot of space to move on the upside because the bigger picture is for Singapore GDP to stay resilient this year. So in all, we are looking for SORA, which is the overnight rate, to bottom at around 1% for the early part of this year before eventually recovering towards the 1.4% by the end of this year.
That suggests rates may stay low for now, but the room for further big declines could be limited, which is why advisors say trying to time the absolute bottom often doesn't pay off. For homeowners who are already out of their lock-in period, waiting can also be costly. Once a lock-in ends, many borrowers are automatically moved onto higher-priced packages, often paying more than what's available in the market today.
It's very important to check out what you can change your interest rate to, because the longer you wait, you may miss out on the lows. So 1.4% is kind of the second lowest rate you get in the past 15 years. So why not do it, lock it in earlier rather than later? Then for floating rates, the spread may increase. In fact, the spread should increase. It's too low already. So if you wait longer from SORA plus 0.35, you may get SORA plus 0.5 if you wait 3 more months.
If you're paying a higher rate while waiting for a slightly lower one, you may end up losing more than you gain. Which is why advisors say the decision today isn't just when to refinance, but how to structure the loan.
What is the risk reward? If you're waiting just for interest rates to come down 10, 20 basis points, and in the meantime, you're paying 80, 90 basis points more, then is it really worth the wait? So we have to do the math in this way. I think rates are already quite at a sweet spot. If we're expecting rates to go down further, to closer to the 1%, that also means that maybe the system needs a kind of a shock to go into that 1%. So I think rates might remain stable.
So how should homeowners structure their loans? For many, the first consideration is life stage.
If you're a homeowner and you're staying in a house with a family of 5, you've got mouths to feed, you probably don't want to take on that risk, unnecessary risk, because you are paying for the monthly mortgage installments. Then you prioritize stability over any sort of opportunity. Most people are still going for a fixed interest rate, naturally, 2-3 years, because if the forecast shows that interest rates are going to go up, then why not fix it now for longer? So very natural for these people to do it. For the most part, the sentiments on the ground is that interest rates are cheap now. So if I can get a fixed interest rate at 1.5%, I want to lock it in for the longest time.
Others, however, are more comfortable taking on some risk, especially if the property is an investment rather than a home.
If you are, for example, owning an investment property, the property is rented out, it pays for your monthly installments, you have the ability to take on a little bit more risk, maybe you want to go for a variable interest rate. And when you go for a variable interest rate, why? Because you may be in the narrative that, hey, interest rates may trend lower. I want to save a little bit more, right? You can take that risk.
Fixed rates remain popular, especially when they come with flexibility built in.
The banks offer you this thing called a free conversion. A free conversion allows you to go back to the same bank after a year, and you can relook at the options out there that the banks would give you. And if interest rates are more attractive, you just move into that rate. So a lot of flexibility. They not only offer a fixed interest rate, they also offer you a variable interest rate option. So if really things go south and economy really spirals into a recession, then at least you have that option to move into a variable interest rate to ride the wave down.
But when borrowing costs are already low, some homeowners are also rethinking how they use their money, not just what rate they pay.
If you're looking to use CPF to pay down on your loan, you have to understand that CPF, if left in your ordinary account, earns you virtually risk-free 2.5% per annum. Bank loans today charge you 1.3, 1.55%. It's more efficient to take a bank loan and leave CPF in the account to grow. Not so efficient to use CPF, put it into the property and take a lesser loan.
Clive adds that this also affects how much cash homeowners get back later.
When you sell the property, you would have to pay back CPF whatever you've used plus accrued interest. So you are paying yourself that 2.5%, right? The actual impact on that is that you will be eroding your cash proceeds.
When money is cheaper, smart homeowners stop chasing rates and start thinking differently about how their loans are structured. Because when it comes to your home, certainty and the ability to adapt often matter more than squeezing out the last few basis points.
I think what people have to consider is there's so many packages in the market today with so many different features. It's the features and the flexibilities that we should focus on today, rather than just the headline rate. That is more important. The flexibility, it's of a priority in today's market. Yeah, because rates are already low, right? So we want the ability to be able to adapt to different market conditions. You go for a float, there are packages that would help you hedge your risk. You go for a fix, there are packages that will help you, give you opportunities. So we're in an environment where it's, that you shouldn't be sitting on the fence thinking whether you should refinance. It's whether I'm going to refinance into a float or whether I'm going to refinance into a fixed. Yeah, then we take on the packages that would give us that flexibilities.